In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, good afternoon, Market Rebels. It's that time again. Market close today, Thursday, 4 p.m. Time for another episode of Coach's Corner. So if you're new,
it is that time. Yeah,
it is that time. If you're new, it's great having you here. And the basic ideas, we try to show some of the finer points about options, trading strategies that most people overlook. And we're often joined always by Stu, one of our world-class coaches, and sometimes by Scott Thorstensen. But we really try to just show you some of the finer points of options as opposed to saying, let me predict the market for you and buy these stocks. That's not going to get you anywhere.
No.
So today, we're going to do a little bit of a follow-up from last week, and I think it was called Where Are Your Profits Coming From?
Yeah.
And in that one, we talked about mostly delta, gamma, and even an example of theta, and showing how to break those down. So if the stock goes up, how much of your profit came from each of those three groups?
Or your loss.
Or your loss. And I intentionally left out Vega in there, partly because I wanted to start out easy, but it's also because Vega almost belongs in its own separate corner because there are so many different ways that Vega can throw a wrench in the works. And so you kind of think of this as a follow-up. So if you didn't see that one, you'll want to check out Where Your Profit's Coming From, and this will also be kind of the fourth Greek there to throw into it. So let's get started with this presentation, Vega, the risk you never see. Now, the reason I like to call it this is that, traders see the stock price move. They'll see possibly interest rates move. They'll see they see time going by. They can see the clock. Okay, I can see theta. But they never stop to think about volatility.
Yeah, everybody wants to look at the theta number. What's my theta? What's my
theta? But they never stop to think, hey,
absolutely, without thinking about the Vega risk. Absolutely.
It's exactly like this graphic right here. There's so much more that you're not seeing, and that's usually going to come from Vega.
Oh,
so if that's all,
I didn't even notice that the iceberg's under the water, huh?
Oh yeah, far more of it is underneath it than on the top.
Okay, nice.
But so for anybody who might be new, that's something to keep in mind. If this is new to you and you're going, hey, this sounds a little strange, maybe you want to take a little pause on selling those naked puts, thinking that you're getting free money. So let's start off with Vega, the risk you never see. And as always, we're going to kick it off with a little brain teaser, a little thought question here that we call Chalk Talk. So here's our coach's huddle. We're going to start off with a question here. The stock is at 200 and you sold a 30-day $180 put at 20% volatility. Now, remember, this is 20 points out of the money.
Kind of a low vol stock, 20.
In a low vol stock, you'd say, you know what? I can't imagine the stock's going to fall to 180 in 30 days. Let me sell these puts.
Sure.
And of course, they're probably not going to cost a whole lot, so you might need to sell them 10 or 20 times. And guess what? You just knocked out your car payment or your rent, and you're going, hey, this is really cool.
Yeah.
Well, the question we want to ask, is this a low risk, high probability trade? And I know you know the answer, but most of them don't. And the reason we know that because we get, I know especially you and Scotty from the coaching perspective, get this all the time. People saying this is the strategy I want to pursue because somebody on YouTube told me about how to make every Friday a payday by doing, and it's usually this strategy.
Bill, it's a 20 vol stock. It's not really going anywhere.
It's not going anywhere.
And hey, Stu, I'm going to look at the ATR, and the ATR is, 1.25. I'm cool. No problem.
Yeah, we're cool. Let's just start selling these things.
But,
and you're going,
these puts are 75 cents. So, what's that?
Or 20 cents. Yeah. And they now you got to sell them 10 or 20 times.
A bunch of them because, it's free money. So let me just take the money in.
And that is an easy trap to fall into. And that's what we're going to show you here. So let's start off at the beginning, little recap. Now, again, this is not intended to be a full-blown course. There are so many moving parts. We're just trying to give you the idea of the risks that you're not seeing. So let's start off with a quick definition of volatility. Volatility, for any of you who have had statistics, if you stayed awake in it, remember a term called the standard deviation. There's a way we can take all of those closing prices, do a calculation. You can do it in Excel, standard deviation, and it will spit out a number. And what it's telling you is kind of loosely speaking, the average distance from the center. We know what the average is, our average outcome. How far are these extremes from the average? On average, kind of to think of it. That's what we call volatility.
Bill, can't we kind of just look at the straddle and kind of
that's one way to do it. Yep, that's a little trader's inside tip. I know you guys teach. We talk about it in Q&A a lot as well. Mm-hmm. But it's just conceptually, you can think of it as a bell curve. It's the width of the bell curve. So if you have increasing volatility, what happens? The bell curve gets wider. And that's showing that there's now a wider range of possible prices up or down, which are going to benefit the calls on the way up, benefit the puts on the way down. So that's one way to understand all options, calls and puts are going to increase in price when volatility rises. So as things start getting a lot shakier in the markets, that might be a way of understanding where volatility is coming from. Prices might be slow and steady up, and then suddenly they start getting a lot more zigs and zags in them and a lot more uncertainty. That's conceptually what volatility is.
And Bill, that can happen to the upside as well. You might get a stock into a situation where maybe it's in a takeover environment.
Oh, yeah.
Or maybe into an earnings environment. Or
we see a lot of that in the UOA.
Biotech with the FDA.
Absolutely.
It's not just the downside, everybody. It's also...
It can be to the upside. The downside is usually more pronounced, though. Usually. Not always. But like you said, if there's a big announcement on a biotech, man, the volatility can absolutely explode to the upside. So that's where that's coming from. Really what it's coming from is traders just bidding up option prices or down based on perceptions in the market. So as these prices go up or down, we put that into a pricing model and it says, hey, the volatility is increasing. The crowd's perception of what's going to happen in the future is now becoming more uncertain. So visually, this is what it looks like. This might be let's call it maybe a 20% volatility. And we know that the center right here is the current stock price, right? Doesn't mean the stock price when you bought the option. It's today's stock price. That bell curve
Bill, can you repeat that? I think that's really important. People kind of miss that. They're so focused on what they did, and they're not really thinking
exactly.
The world is happening around them. So just say that.
Yeah, the stock could be out here, and they say, well, the center is down here. No, it's not. The bell curve is always over. The center of it is always over the current stock price.
Current stock price.
The current stock price.
Right. It has nothing to do with where you bought the option or where you bought the stock or sold it or this or that or your profit. It's where are we now?
Where are we right now?
Yeah.
So this might be, let's say, 20% volatility with 30 days to expiration. We're going to get some kind of a bell curve. Let's say that volatility doubles. Conceptually, what's happening is that the curve is getting shorter and wider. There's less of the kind of the area in the center, and we're starting to see more area out here in the wings. Now, I've exaggerated this to kind of make the point. But that's really what's happening. We have more possibilities out here to the left and right. You can see the range of prices in the green is wider. We can go from way out here to the left side to way out here, whereas in the red, we're within much narrower band.
Let me make a quick statement here, just
Sure.
to kind of bring this home real quick. So everyone, think about the market and what markets do, and think about the VIX. I know everybody likes to look at the VIX. VIX is currently we'll call it 15.
Pretty low.
What is happening in the world? What is happening in the market when the VIX is 30? Right. That's when the markets are up and down, 800 points instead of 200 points. Mm-hmm. Well, how about 40? It's a wider range. This is what Bill's talking about. Yeah. The range of pricing is much wider.
It's expanding. Yeah.
And that is what the volatility is measuring. It's measuring the range. It's not necessarily measuring direction.
It definitely is not measuring direction.
Right. It is measuring range. And as the range gets bigger, it's not really our interpretation of it. It just is, right? It's just getting bigger. And therefore, the pricing in the options has to accommodate larger ranges. And that's what you see in the increase in pricing as the volatility is going up. It's not like, oh, we're going to push the volatility up, right? The volatility is just a metric. It's just a measurement of the pricing in the options to accommodate a larger range.
Larger range because of the uncertainty. All right, so let's see how this is going to end up becoming a risk for us. Or it could even be a benefit, but we usually like to focus on the risk. Now, before we do, as always, please be sure to check us out, marketrebellion.com/get started. Absolutely free, great articles, videos, and things to help you get on the right track before you start trading options. So check us out there for more great information. Yep. So we just talked about if volatility increases, in other words, the uncertainty increases. So we've gone from maybe a 20% vol to 40%. Why is that a benefit for options? It kind of is weird because in the stock market, volatility is risk. And risk usually reduces prices. We actually talked about that not too long ago here in Coach's Corner, and we showed hypothetical auctions. And as we increase the risk, what happened? Price goes down, reward goes up. So the question is, why do option prices increase when uncertainty increases? Kind of weird. Well, here's why. Let's say we've got a $100 stock and we're looking at a $100 call. Now, this top line is the stock. The second row is for the call, but let's start with the stock. If you buy shares of stock at 100 and you sell it for 100, you made 0. Stock goes to 105, you made 5, or maybe you're up 5 if it's trading at 105. Stock at 110, you're up 10, 115, and so on. It's just dollar for dollar up.
Right.
But it's also dollar for dollar down. Stock falls to 95, you're down 5, down 10, and down 15.
So let's go to in between the lines here. Look at these numbers, everyone. They're not changed. The incremental changes are not changing.
Yep.
Right.
Delta one.
Dollar for dollar for dollar for dollar and it never changed. Doesn't matter what the stock price is. Could be 500. It's still dollar for dollar.
Dollar for dollar. Right. Yeah. And that's why stock traders normally don't talk about this or delta because it's just so obvious.
Because
you own the underlying.
Why would we talk about it? 500 shares is 500 shares.
Right. So the thing to notice is that it's symmetrical. Okay. I've got 5, 10, 15 on the right, and I have 5 or minus 5, 10, minus 15 on the left. But it's like a mirror image. But now let's drop down to this bottom row and say that we have the 100 call. All right. So first of all, notice that for the stock, we are gaining if it rises and we are losing if it falls, dollar for dollar. So now for the option, we've got the $100 call, regardless of what you paid for it, but we're not up or down. We've kind of broken even right now with the stock at 100. Or let's just say that maybe we'll put it at expiration. That might be easier. Stu, we'll say it's worthless at expiration.
Okay. Doesn't really matter.
If the stock is 105 at expiration, you make 5 points of intrinsic value.
Yep.
Stock is 110 at expiration. You make 10 points, 15, you make 15. Notice that it mirrors the stock.
So time out 1 second here. So, for those of you that have trouble answering the question, which you should always be asking when you're putting together an option strategy, is what will these prices be when the stock does and when you fill in the blank? Strip away, start at the end. Strip away the extrinsic value, and what are you left with? That's going to be the intrinsic value. And this is what you have. It's very, very simple.
Yep. So if we go to the other direction, now here's where things start to get interesting. Let's say that the stock drops to 95 at expiration. Well, the call is still, the payoff is zero. Now that doesn't mean you lost zero, but sometimes what we call the options payoff. What do you receive for it at expiration? Zero. It's worthless. What if the stock drops to 90? Payoff is zero. Stock drops to 85. Payoff is zero. Notice that on the way up, you gain dollar for dollar, at least at expiration, just like a stock trader. But on the way down, you don't lose. See, this is what we call an asymmetric payoff. So once you've purchased this option, let's say at 20% volatility, would you rather have it go to 40% or 60, 80, 100? Sure, because that's only going to push this right side up without really causing damage to the left side. See, that's not true for the stock. So that's why increasing volatility is a benefit for options, calls, and puts. Puts would just be going in the other direction.
So you know what I just thought about, which is not really part of this topic, but I'm just going to throw it in there anyway, because that's the kind of guy I am. Suppose you have a covered call. Everybody look at this diagram. Suppose you have a covered call. The stock is going against you. Stock is going down. What are you making off of the option? Goose eggs, nothing. What are you doing with the stock? You're losing. Where's the comfort of the covered call? Where's the, like, oh, I'm hedged. Where is it? It's gone. Once that option goes to zero, that's it.
Yeah, it's gone.
That's it. Yet you still hold the stock. Synthetically, of course, is a short put, and we're going to talk about that, I think, in a little bit. But go ahead. Yep,
all good points. So again, if it's confusing to you, this is exactly why you need to understand it. This is why traders get into traps. And of course, what do? Blame the market makers. Easy to do.
Yeah.
So let's now start off with our next step. Now that we know what volatility is and why it's a benefit for options, not for stocks. What is Vega? Well, Vega is one of the many Greek sensitivity measures. We know there's delta, gamma, theta, Vega, rho. There's actually others, which we've talked about before, some of the second tiers. Vega is technically not a Greek letter of the alphabet. They actually don't have one for V. So when they were making these things up, they just came up with one that kind of sounded like a Greek letter. But that's where Vega comes from. And what it does is it measures the size of the volatility benefit. So just a moment ago, I said increasing volatility is a benefit for options, calls, and puts. All right, well, how big of a benefit? Is it going to double my options price? Triple it, or is it going to bump it up 5%? How big is that benefit?
Felt. I mean, we're assuming we're owners of that option, aren't we?
We are at this point assuming we're owners, yes.
Okay, I just want to make that clear. Okay.
Yeah, typically whenever they show the option Greeks on your platform, that's for a long position. Once you see it, the short position would be exactly the opposite. Yep. So now Vega measures the change in the options price for what's called a 1 percentage point move in volatility. And in the business, we call this
a tick.
Call it a tick.
Oh,
that's what you guys mostly talked about on the floor. We typically do too, but I think most people, or at least will understand it better to say it's a 1 percentage point. Now, the reason we say percentage point, we don't mean a 1% move. So if you're going from 20%, you're going to 20.2%. That's not what it means. In other words, if volatility is currently at 20% and we increase it by one tick to 21%, that's a one tick move up or a 1 percentage point move.
Yeah,
100 basis points.
Is measuring the change.
On the way down, it could also fall from 20 to 19. That would be a one tick drop,
right? Or
a 1 percentage move down. And Vega is measuring what's going to happen to your option for this very small range. Now, like all Greeks, it's also important to understand you can't say, well, I've got a Vega of such and such. So if volatility goes from 20% to 80%, I'm just going to scale that out. Going to get a very wrong answer. Yeah, they're for very small ranges. And technically speaking, even one full tick is too big. It's just easy to conceptualize.
Yeah, we have to work with something. So
we've got to work with something. It's just, and you're going to be super close. Don't get me wrong, but it's not good. If you look at a pricing model out to 4 or 5 decimals, it'll be off a little bit, and that's why, because that's technically too big.
Yeah, but what you should be thinking about, everyone, is just like go out. Go out to the extremes. What happens if the delta goes from 50 to 80 or 50 to 90 or to 10, what's just, you don't have to have the number, just have an idea of which
Have
way
an idea of what it's going to do.
now have an idea that you're going to be losing Vega as you start to move away from the at the money.
Yep. So let's take a look at an example. So let's say we have a $100 call priced at $4. Volatility is at 30%. And you can do this in a pricing model. And I would encourage you to do that.
Yeah.
And you're going to look on that pricing model and you'll see the term down there. It'll say Vega. And let's say it shows 0.11. What that means is that if volatility increases from its current number by 1 tick from 30 to 31. So in other words, we go into our pricing model. I originally typed in 30%. If I type in 31%, what's that going to do? It's going to add Vega to my original options price. It's going to go from $4, going to add 11 cents. The new options price will be $4.11. And if you put that into a pricing model and change that to 31%, you'll see that the new option price is $4.11.
Right. And how about if we went like 30 to 40? That would be 10 ticks times
10 and that's going to start to get off a little bit, but it'll still probably be pretty close.
Close enough.
It'll certainly be close enough.
Definitely close enough.
I'm just warning you, don't be scratching your head going, how come it's not exact? The math must be off. The math isn't off. It's just that our assumptions about that it applies over wide ranges is
and
off.
Also this 11-cent Vega, that's kind of fairly small. You might say, 4.11, who cares? So what?
But how often does volatility move 1 tick, right?
Not too much, right? You're going to get bigger when it's moving. You're going to get bigger.
It's either not going to move or it's going to go from 30 to 40, right?
And additionally, understand that when you have these higher price stocks with higher prices of the options, terms, you might get Vegas that are $1, $2.
Easily.
And so
it can really swing.
You make a
and then
big
you
difference in pricing.
Get a big swing in volatility, and you're going, "What happened to my options? The stock didn't move.
Oh my God, what happened?"
The risk you never see. So the thing to understand is that Vega and time have similar effects. And I like to mention that because when traders are new, they go, "I don't understand." Well, if you understand that Vega or volatility is a way to increase your options price, and increasing the amount of time is also a way to increase the options price. They're just two different ways of allowing the option to gain more value. So if you increase volatility, option prices go up. If you increase time, option prices go up. Reverse is true if you decrease volatility or time. All right, so Vega and time both allow for the stock to make bigger moves if we are increasing volatility or time.
And again, everyone, that kind of shows up in the extrinsic value.
Oh yeah, not going to show up on intrinsic. Correct.
That's where you're seeing it, right? That's the as you go out in time, you look at the same strike as you're going out in time. You're seeing the prices go up. That's the extrinsic value going higher. That's the increase in.
That's because of this right here
that we're looking at.
Yep. So now let's look at some of these time and volatility relationships. Remember, increasing time or volatility increases option prices. And of course, decreasing would do the opposite. It's going to decrease your prices. But again, here's where one of the risks come in that traders overlook. The rate of change is very different. So we've talked about this before on Coach's Corner. It takes about 4 times the amount of time to double an options price. That's assuming at the money. But it takes 2 times the volatility to double an options price for an at the money. Kind of weird. So for instance, this is one of the examples we used in that presentation. If you have a 1-month option trading for $1, most traders would think that a 4-month option is trading for $4 because you've got 4 times the amount of time. And that's not true.
Negative.
We see that there's 4 times the time. We have to take the square root. Why? Because volatility is proportional, or option prices are proportional to volatility. We have to take the square root of 4, which is 2. And this number right here in green shows us our scaling factor. This 4-month option is going to be 2 times the price, not 4 times. So we would expect it to trade for about 2. I say about because there will be skews in the market. If it's maybe a little less, that might be a perfect calendar spread.
Yeah, you might have a tilt one way or the other. So, this kind of begs the question of, which we've asked several times on this show, which one's cheaper?
Yeah.
Which one's cheaper, the 4-month or the 1 month?
One's relatively cheaper, one's relatively expensive, right? So the point that I want you to see for right now is that it takes 4 times the time to double an option's price. But watch this. What if we have at 20% volatility, the option's trading for 10 at the money, 40% volatility, it's going to trade for 20. See, what happens if we double volatility, we double the price. All right, so now we see that it takes 2 times the volatility to double an option's price, again, at the money, but for time, it takes 4 times the time. And this is why volatility can really catch you by surprise. Here's a very cool graph. I just made it in kind of a relative, I'm calling it the multiple on the bottom. In other words, 2 would be 2 times the time, 3 would be 3 times the time, or 3 times the volatility. And then we're seeing what it's done to your price. Has it made it 2 times as expensive, 4 times, 6 times, and so on? But look at the red curve. Red and blue are kind of similar when we're less than 1% or one factor of 1. But look at that red curve start to taper off. So for example, let's say if we give 4 times the amount of time to our option, what did we just say? That's going to make 2 times your option's price. But it's going to make 4 times if we double the volatility.
Remember,
if we quadruple the volatility.
Time.
It does not follow the square root rule, right? But now watch this. You go out 10 times the amount of time.
Huh.
That option's going to be a little over 3 times the cost.
Price.
Square root of 10 is going to be what, about 3.2, 3.16, somewhere in there.
3.16. Man, you smart.
Let's call it about roughly a little over 3 times.
3. There you go. Okay.
That's a very good one reason for potentially buying time. Getting 10 times the amount of time, but only paying 3 times the amount. So the cost per unit of time goes down greatly. But look what happens if we give it 10 times the volatility.
Ooh.
That option's, ooh. Right?
Ooh.
So go back and think about GameStop when it went from 80 to 650.
Yeah, why did the puts go up as the stock was going up?
Stock was going through the roof and the puts are going up. It can catch you by surprise. So this is good.
What I want everybody to really do with this is, as you're listening to this and watching it, start thinking about strategies. Right?
Oh yeah,
if I want to recognize that I have that I want to make a bet on implied volatility, how can I do it? The easy answer is, well, let me use the VIX options, which is probably a dangerous thing to do if you don't understand the product. It's a very difficult product. But there are strategies where you can remain delta neutral and you can actually bet on implied volatility. And then there are strategies where you may already own an option and volatility makes a move, and you may not really understand that you are now at a different risk factor than you were before because of the move in implied volatility, and maybe you want to mitigate that. But if you don't really know that it's there, right, then you're not going to make that move, and you may wind up giving it all back.
Absolutely true. So the main thing to look at is look at this gap, how it starts to widen when these multiples go up. You get a 3-fold increase in volatility, 4-fold increase. It's going to have a very big impact, positive or negative, on that option. You need to be aware of that. Far more than maybe, or we could also go in reverse. Your options value has half the time has gone by. So it's not going to have the same impact as volatility dropping. Let's say if it's for a long or a short position.
Yeah.
So you need to understand how those are going.
If you have a high Vega number or a higher Vega number, think as you're out in time, as you're maybe doing a diagonal using a farther dated option, and
we're going to talk about that. I threw in an example of that. I knew it's a great example. This is exactly why you have to understand this stuff. So that's the main point for right now, that the impact of volatility, even though we know for sure time is going to go by, at one point it'll have half the amount of time on it. It's not necessarily true for options or for volatility, but if it does move, the impact can be severe. So another thing to understand is that Vega is greatest for your at the money strikes. So it's greatest for at the money, and it will slowly get reduced as you move to in or out of the money. Vega is also greater for longer dated options. As Stu just said, as we go out in time, keeping everything the same, it's going to increase. So for example, let's say that we have the stock at 100, volatility at 20%, 90 days to expiration. The at the money strike, these are strikes down here. The 100 strike is going to have the highest Vega. So whatever number is over here, that's the number we would see on our broker's platform. But notice how it starts to taper off as we move away, whether we're going in the money or out of the money.
Think about what's happening to the extrinsic value in an option as you're
That's
moving
exactly right.
away from at the money. In the money
Starts dropping.
or out of the money. We all know that the call will go down in price when the stock goes down. Well, what's going on, right? You're losing dollars, you're losing extrinsic value, you're losing the punch of the change that's going to happen. There's just simply not as many dollars. Same thing on the upside, right? The synthetic put, if you kind of can do that, it's the other side is that put's going down, the extrinsic value on the call is going down, and it doesn't have as much of a punch. That's what Bill is showing here.
Yep. So let's take a look at now another dangerous area of Vega. Now that we've covered the basics, what it is, where to find it, where it's the greatest, let's look at normalized Vega.
I knew you were going to go there.
You have to. It is such a great topic, and nobody talks about it.
Yeah.
And what this is, we could actually do it for any of our Greeks, but it's Vega as a percentage of the options price. And that is going to be greatest for out of the money. All right, so if we look at Vega, remember it's a number, but if we look at it relative to the options price, it's actually going to be larger for out of the money. Now, we just said that Vega was largest for at the money, but that's the raw number, what we call the absolute value. The actual number is largest. But if we look at the relative number.
Yeah, think of it, just step outside this box of information. The out of the money option the extrinsic value on the out of the money option is going to be lower. The dollars are lower. Mm-hmm. So when you're talking about changes, because you have lower, think of the whole leverage thing. It's going to be a bigger number. That's the normalized Vega that Bill's talking about. Yep.
So in fact, the further out of the money, the larger the percentage change in the options price from Vega. This is a huge statement right here for everybody who's new. When you think you're selling these far out of the money options, and you don't realize it, that this is what your graph looks like. Okay, here's the stock is 100, volatility is 20%, 90 days to expiration. If we take the Vega divided by the options price, look at that. Remember, we saw it before, it was a bell curve. The peak was at the money. No longer true. It's big. I mean, we are registering something, but look what happens when we go out. It's just going off the rails. And I actually had a guy one time, I was doing a presentation for a club, and this guy came up and said, what do you think about this strategy? And he was talking about this thing right here. He's talking on selling these out of the money puts on SPY. And I said, well, you have to realize, I said, there's a lot of different potential dangers. He said, well, no, you don't understand. I'm going way out of the money, way out. I said, every time you throw in a way, you're making it that much riskier. He was trying to convince me that he was making it super, super safe, and I didn't realize. I said, that's exactly the risk that you're not seeing.
Yeah,
it's this right.
See, there's this phenomenon in the market where if those puts are coming into play, those way out of the money options, if those puts are coming into play, it's because the stock is dropping. Oh, yeah. And if the stock is dropping, there's a reason why it's dropping, and
that's right,
not real good. And therefore, the perceived range is now increasing, and the vols are going up, and that's what's going to bite your behind.
Yep. In fact, here's why. Let's say here's maybe, again, roughly speaking, 20% volatility in red. This is what we saw before, and maybe a 40% in green. Now, again, this is exaggerated, but I'm doing this just to widen out these tails so you can see what's going on. But take a look at this. Do you see this area to the right of this dotted line, this little triangle in the red right there?
Yeah, I see it.
That's giving us, that area is what's giving that option, if this is a strike price right here, value. Not a very large probability of that stock going up there. So it's got maybe potentially very big dollar amounts. That might be 120 or 130.
Yeah.
But the probability is so low, they're saying, yeah, the option might be worth $30, but it's so low. It's making it worth pennies. But look what happens when you increase that range. Look at the amount of area to the right of the dotted line in the green, actually the green plus red, relative to just the red. It's massive. That's what was causing that acceleration, because you're out here in the tails, you're accelerating those tails. So you don't get that here in the center.
See, again, everyone, it comes back to the range, right? That's what this is all about. That's what option pricing is all about.
So it's the whole pricing is about.
It's about the range. When the range is changing, you're going to get changes in pricing. And this is what the Vega is measuring.
And you got to be aware of that. And now we're going to show you why. And before we do, as always, marketrebellion.com/get started for lots of great articles and videos. So now, Stu, we've covered the who, what, where, how, all that kind of stuff. Let's look at some examples. Let's start off with, kind of just talked about it, the risk of selling out of the monies.
Okay.
These are actually safe because these are way out of the money options.
Way,
you don't understand. Way out of the money options.
Yeah.
All right. You're going to see why that's a risk. Yes, at the money options have the highest Vega. Check. True. No argument. But the out of the money options are the most sensitive to volatility in percentage terms. Don't forget that. So, for example, if you don't believe it, here's right out of a pricing model. Up here we have the underlying price. That's our stock and our strike at 200. This is an at the money option. I'm going to price it at 20% volatility.
Fairly tame.
Now down here, we're going to double volatility to 40. That's the only change that I'm making from this top chart to the bottom. And look what it did to our options price. It went from 457 to 914, exactly double. This is what we just talked about for an at the money option. But now people say, well, what if I go out of the money? It's got a very low Vega. I mean, look at my Vega down here. It's 0.23. What if we go out of the money? Well, let's do it. Let's do the stock still at 200. Let's look at the 180. I'm going to use a put. So this is an out of the money put. Look at my Vega is only 0.04, Stu. A lot better than 0.23. That's nothing.
Yeah, but Bill, I'm only getting 14 cents for that option.
Oh, good point. So what do we have to do if we're going to make every Friday a payday?
I got to increase my volume.
Right. So if you want to make your car payment, you're going to have to sell this, depending on what kind of car you have, 20 or 30 times. If you got a Tesla, you might have to do it or 70 more, or 80 times.
You're driving an Enzo or something. I mean, you know.
Then but you get the point. It's it's $14 per contract, 140 per 10.
Yeah.
So you might say, but the chances for the stock to get to 180 are pretty slim. And you know what? I would agree with you.
Yeah.
But you're not accounting for Vega, for volatility. Yeah. So watch what happens. These are out of the money. Again, we're going to assume that they're puts. We're going to start at 20% vol. We're going to double it to 40. Now, last time we saw it did what? 2x to our price. What happens now? It goes from 14 cents. Oh, goes up 15-fold.
Right. So you just dropped $200 per option. 10 of them is $2,000 on a 10 lot on an out of money option that really you thought was safe.
Right. If you pulled in $1,000 from these short puts, laughing all the way to the bank, you're now in the hole for 15,000. And you can think all day long, oh, well, it's going to expire worthless. I know it will. How do I know? Because I'm looking at Fibonacci retracement, whatever, blah, blah, blah. You're totally confident.
Bill's not really picking on Fibonacci's. Could be anything. Not picking on. It's just your opinion about what might happen.
People get opinions about, I know this is going to expire worthless. But it might, but the brokers doesn't care.
No.
The broker says you're in maintenance right now.
Trying to be right. I mean, this is crazy talk.
You either sell stuff now, not 5 minutes from now, right now, wire in money right now, or we're shutting it down. We're closing things and starting to sell to get you out of maintenance.
My broker would never say that.
Of course not. No, they'll let you just write it for free. Now, let's say that maybe you've got the cash. And you say, you know what? I'm willing to risk it.
Yeah, these are cash secured.
These are cash secured. Now, what happens here? Let's say that it goes down. As Stu said, the reason the volatility is popping is most likely because the stock has already started moving. So let's say that it's dropped 7.5%. Not that we've ever seen a stock drop 7.5%.
The stock price here, everyone. Yeah.
What's going to happen now? Now look at our price is $6. It's now 43 times bigger. That $1,000 you took in is now minus 43,000, and it's still out of the money.
Yeah.
This is where people get into trouble. And again, you can think all day long, hey, there's only 5 days left or 2 days left. Let me write it out. It's going to expire worthless.
But Bill,
Too
I'm
late.
cash secured. I'm okay.
And I'm okay. Well, good luck.
Yeah.
You know, take the assignment. You're still going to be down 43,000. Yeah.
Right. You're
still gonna be
out
down.
580 or 90. I mean, it's just crazy. You're out $600 per contract.
Yep. So now that's one of the most important, and we pick on this strategy not because it's a bad strategy, but because people use it who probably shouldn't be using it because they don't understand Vega and normalized Vega. So again, if this is something new to you, hopefully a little light bulb goes off and you go, maybe I need a little more training.
Yeah. And I'm going to say this again. I say this every time. Nobody is advocating that this is good, bad, or indifferent.
They're just tools.
It's just something that
it's a tool
if you're going to be an options person that's going to use an option as a product to trade or invest with, this is something you need to know.
Absolutely.
It's up to you whether you want to accept it or not.
Correct. Let's take a look at one last example. Now, we've done this one before, the danger for calendar spreads. You actually mentioned calendar spreads. I think I did too when we were looking at that square root pricing rule. That's one of the things that sets up a calendar spread. But here's a big trap. Everybody thinks that percentages are money, and they're not. So, for example, let's say that you sell a weekly $100 call at 70% volatility. It's got an FDA announcement coming into it. In this
Bill, I called my bank and I said, I want to pay my car payment with 10%.
With 10% or with volatility, or with
he hung up on me.
No, or with volatility. It's not a dollar. It's a measurement of it. And so you sell this thing going, wow, I sold at 70%. I'm going to go way out under the curve here, buy the 6-month 100 call at 30% vol. All right, so what's happening here? Volatility now, let's say, falls to 20%.
This is a nice skew, right? You may think that's cool.
Oh yeah, you're sitting here looking at the skew, going,
buy
you know
low,
what?
sell high. This fits the modus operandi here. Buy low,
of a lot of people with the diagonal spreads. Right.
Yeah.
So for any of you doing diagonal spreads, be very careful of this trap. So here's what traders think. Yeah, I knew that volatility was high and that it was going to come down, but I made 50 percentage points on my short.
Yeah. How much
and I
money?
only lost 10 percentage points here. So I'm up like 40 percentage points.
Yeah. Yeah. How much money is that?
Yeah. Well, good question. Let's find out. According to a pricing model, 6-month option, you had to shell out $862 for it at 20% vol. The weekly, you collected a whopping $387. So your net payment was $475 for your beautiful calendar spread here.
Okay.
Now, when the weekly expires, our 6-month, when our volatility falls to 20%, the 6-month option is worth $583.
That's on the 30.
We get to collect it because we're
down to 20 vol. Okay.
Yeah, we're gonna sell this one.
We lost 10
and then
cents.
the weekly is now minus 11. We're going to have to spend $1.11 to close that out. So what's the net now? $472. It is a 3-cent loss, even though it appears that volatility went massively in your favor. What backfired?
You had a 40-point skew in your favor.
What backfired? What backfired is that the Vega on the 6-month is far bigger. So even though it's not a big drop going from 30 to 20, or at least it doesn't seem to be, the amount that it was dropping was bigger. So it's a little bit like saying, hey, I only lost 10% on $1 million investment, but I gained 100% on my short option here. So I'm way up. I gained 100 and I only lost 10%. I'm up. No, you are massively down.
And this is a conservative. If I made this presentation, I would have actually made it a lot worse. Which is typically
what happens. I try to do it where it looked like it was a massive gain and it was really just basically breaking even.
Look, it's a great example. Break even. Okay, I didn't win. I didn't lose. All right. So what? But a lot of times what's going to happen is you're going to lose $10 and you're going to make, $3 or $4. You're going to wind up losing $6 on the calendar or the diagonal. And what happened? And
even if the stock moves in your favor.
Yeah.
You might be moving in your favor.
You might have had the right delta, but you had the vol move against you and you got wiped out.
You had the wrong volatility. Right. That's the point to understand. So once again, we hope you picked up some good.
It wasn't really enough. It was, 40 ticks is nice, but it wasn't enough to cover what eventually happened.
Correct. So we hope you picked up some good little tips here. And again, if a lot of this is foreign to you, that's fine. You still learn something. You realize there's a lot of things that you don't know. And the thing that we find most often where people fail is with Vega. Why? Because it's a risk you never see. So back to our chalk talk question. We had stock at 200. You sold this 30-day 180 put. Keep in mind, that's way, way, way out of the money. Is this a low risk, high probability trade? Go into all your message chat boards and YouTube and say, yep, make every Friday a payday. What do you all think now? In fact, Stu, I'm going to take even a little bit of the other side. It's high. It might be high probability in the fact that the stock is probably not going to hit 180.
Yeah.
But what are you overlooking there? People who say that. Well, what's the thing you're going to tell them as a coach?
That their 20 vol might go to 30 vol.
Yeah. I wouldn't call this safe.
Right?
I wouldn't call this safe at all.
And maybe you're going to wait it out. I'll wait it out. I'll wait. Well, meantime, now you're dealing with Delta while you're trying to wait out the implied volatility problem that you have. And while you're waiting it out, the stock might drop another 10 or 20 points.
Exactly. You might be right. It might expire worthless, but it also might drop another 10 or 20 points.
Yeah.
And you dig a deeper hole. So this is why we tell people, hedge your risk before you get into the positions. So I hope that gives you some good things to think about. We know there's a lot to talk about. So again, you might have to replay it, but we hope that gives you some good points to consider, especially for anyone who likes to sell those naked puts way out of the money. Yeah. And we will see you next Thursday on Coach's Corner.
We will. Take care.